Keep in mind, like the IRS has seen every trick in the book.
Even though there's the general rules of cash versus accrual, there are exceptions to just about everything.
Welcome to the Tax Mastery for Solopreneurs show. I'm Sam, I'm your host, and I'm here with Daniel Sleep, our CPA, certified tax strategist, and the founder of OpenShield Tax Advisors. And then with us on the call as well, we have Camilo Rojas, our senior tax advisor at OpenShield as well. We're all about saving solopreneurs hundreds of thousands each year. A quick disclaimer, the things that we talk about in today's episode, not everything is going to apply to your situation. So make sure you consult with your CPA or with us personally before applying these strategies that we talk about. In today's episode, we're going to be talking about cash versus accrual. So we're going to be talking about which accounting method should solopreneurs choose. We're going to talk about three different areas, which is kind of understanding the basics of it. We're going to talk about implementing it into your tax plan, and then when you should switch between the two or make the transfer. So let's go ahead and just talk basics first. And Daniel, I'll ask you kind of the first question, but what's the difference between cash basis accounting and accrual accounting in simple terms?
Cash basis is what we see more often than not, and it's a simpler, more straightforward way. Essentially, you're recognizing and you're reporting the cash that's coming in the business and also the cash going out. So, and that's, I would say, typically how most small business owners run their business. I would even say we have seen a few people where we can see on their tax return that for some reason their preparer noted accrual basis, but we can easily see that when we compare their financials to accrual to cash basis, that there's really no difference and they're truly filing under the cash basis.
Yeah.
But if something were to happen, let's say they finally create an invoice for accounts payable, they need to make sure that if they're being reporting on the accrual basis, they account for that. And I think in the most straightforward terms, if you have an invoice, whether that's for a client that it hasn't paid you yet, or for bills you haven't paid yet, on the cash basis, you're not recognizing those. But on the accrual basis, you are. So that could hurt someone if, let's say, they bill a client for 100 grand and they haven't got paid for it. Well, come tax time, whether they got paid for it or not, they have to pay taxes on the net profits, which will include that unpaid invoice. So that's where you need to understand where accrual and cash basis differ. But there's businesses out there where accrual basis would be better for them because they do want to account for, expenses that they haven't paid for yet. Camila, anything else to add for the accrual and cash basis?
There's a lot. So I'll start it off with this, kind of like a curveball at you. What do you use in your business, Daniel?
Cash basis.
Yep. So you see, the accountant is using the cash basis. Why? Because it's so straightforward. It's simple. You don't have to consider too much. You're not trying to get fancy. You're trying to keep things as accurate as possible to your cash flow. Because for a lot of small businesses and medium businesses, the cash flow matters a lot more than jumping into the little weeds and details of, well, I did this to earn this, and I need to recognize it at this period because that's when I actually did. So cash really is the simplest. It generally is the best option for most clients. There's some strategies where you mix like one entity with cash and another one with accrual, and you have savings there. Personally, I'm not a big fan. Those savings will usually span a year and that's it. And then the following year it hurts you. So it's not my favorite. But yeah, there's a lot of different things. So cash method. Somebody paid you money, you're gonna recognize that as income. That's it. You're done. Accrual, it's very different. It's all about your contracts. Accrual really has three main points to it. You have to be able to identify what your liability is. That's the first one. The second one is you have to have completed some of the work so you can recognize some of that income or the entire income. And you have to know how much you're actually going to be receiving. So the moment you're entitled to that money, you recognize it on your profit and loss. And that's really the complexity of it. And that's where you do get to play some games. It's the way that you write your contracts. If you break down, let's say you're in construction, you have a $10 million contract. If you're on cash basis, You're simply going to be doing as you get paid, right? So if your agreement was every month you're going to pay me, 1/10 of this contract, that's how you're going to recognize it. However, if that's the agreement, but you're on the accrual method and the contract's actually broken down by what is considered a section. So, you're going to work on the foundation. That's section one of the project. Then you're going to build the frame and then you're going to do the outside. As you complete each one of those phases, that's when you recognize the revenue, regardless of whether you were paid up front or at the very end. So some key distinctions there.
And I think isn't that they call that installment sales, essentially, like that breakdown of
No, but yes, installment sales are also a thing that would
yeah,
be used in the accrual method. This is just, when we got away from the accounting standards that we used to have in the past, it was a change within what, the last 5 to 7 years, I think it was. Especially the really large accounting firms, they really tore it apart because it was very rushed. It was not a well done change. And essentially it left a lot open to interpretation based on contracts. And so contracts are something that you can leverage to control your revenue throughout the year.
right. I think the other thing to note, and Camilo and I have seen this firsthand, is even if you're on the cash basis, there are elements of accrual that will still affect your books. So, for example, we have a client where they pay a good amount of sales tax. And sales tax for almost any state that I am aware of, they require you to report on the accrual basis. And so when we took on this client, it was an interesting situation. The prior accountant had been with them for well over a decade, and she had no interest in talking to us, working with us, or helping us just, have this be a seamless transfer because she was retiring.
Hmm.
And so that was definitely a red flag for both of us because typically either their feelings are somehow hurt or they don't want to have to explain themselves. Long story short, we reviewed and we could not get the prior filings that were sales tax to match the accrual reports in the books. And it turns out she was filing it under the cash basis. So, we had to explain to our client, hey, this was done wrong, and you're gonna, if you got audited, they would definitely see, whoa, this is a discrepancy. And if it's not in your favor, that you're gonna have to pay some underpayment penalties, interest, and anything else they can throw at you. So you have to remember that even though you're on the cash basis, if you have to pay sales tax, most often than not, the requirement is accrual basis. So that's what matters most. So we had to really shift things and make sure that we were doing that for now on, but it can get complicated fast. So be aware of the requirements, especially if your business grows to, I think it was 27 million. I know that number changes every year,
I
but
believe it's 30 now
okay. So
for the
there's
small business.
yes. So as your if your revenue grows to that, that 25, 30 million in revenue, you need to be aware of that trigger of switching to accrual basis. And again, if you start to see yourself reaching that 30 million, that's when you really need to assess what is the tax impact on that when it comes to your sales and when it comes to just your overall taxes, and if your flow through that can affect you in a very large way. So it's really important to know all that. But I would say for the most part, 9 times out of 10, anyone, especially a solopreneur, they're going on the cash basis.
Okay.
But I would say this too, the accrual basis, it's good for reporting when you're reporting internally to understand how many invoices do I have open, your accounts receivable, any bills that are coming due. A lot of CFOs focus on accrual basis because that gives them the full picture of what's potentially coming in and coming out as a business and to stay ahead of the curve versus just looking at the net cash of everything.
So you guys, when you're doing tax strategy with, our clients, will you look at this and like, will you ever encourage someone to switch? And do you have an example of like using this as like a way for them to either save money or just optimize their situation?
I would say rarely do we do that. A lot of times it's just a question of why are we reporting this way?
Gotcha.
You can't really just switch like that and say, hey, next year let's just do accrual basis. Camilo, you can
Yeah, I
add in.
think the just in my time working accounting period, the few times we've done an accounting change, the IRS has come back and said, okay, we need you to restate your last 3 years or something
Yeah.
along those
I
lines.
think it's 5 years. Like they look at 5 years and see like what is the overall difference? Because the last thing the IRS wants, and keep in mind, like the IRS has seen every trick in the book. When we see somebody that's like, oh yeah, they're not going to see this coming. You have to realize there's millions and millions of people that are thinking and have and decades of history. The IRS has seen it all. And so somebody thinking they could simply switch to accrual because it's going to lower their taxes for maybe a year or two, they're going to look back and they're going to say, well, let's see the overall effect of that. And if there's a difference that's material enough, they'll be like, okay, well, let's reassess the taxes you should have paid on the accrual basis. So you want to do that first to make sure that it's not going to affect anything when it comes to that. But they know the tricks, the IRS. They know, like if somebody's switching, they know it's because it's in the business owner's benefit. So, which means it's not in the IRS's benefit. So they're going to be looking at, okay, how do we make sure that they'll allow you to make those switches, but you have to follow their procedures so that they can assess if you owe them more money.
Yeah. Any other comments on that, Camilo?
Yeah, you have to keep in mind that just because something that you do is going to save you money on taxes does not mean it's going to net you savings, right? So if you look at something like changing your accounting method, you have to redo your last 5 years. No accountant's doing that for free. So, it's depending on how complex your return is, how big the work is, you might be looking at a week's worth of work or 2 weeks worth of work. So you have to take that into account for the cost. And it's not as straightforward as, yeah, I'm just going to change this and be done with it. But we know taxpayers like to get a little creative in order to pay less in taxes. So we'll also see things like somebody say, "Oh, I'm just going to prepay my insurance for the next 5 years because I'm on the cash basis. So I'm just going to lower it by that much more." And well, you can't, because even though there's the general rules of cash versus accrual, there are exceptions to just about everything. So if you do any prepayments, you can take them in the year that you're paying them up to a certain limit. And that limit's usually going to be whatever you're paying, but it cannot exceed more than 12 months, and the benefit cannot extend past the following year's tax filing deadline. Well, the end of the year, the calendar year. So let's say, today you paid 5 years worth of your insurance. You'd only be able to take what you have for this year and what you have for next year. Except here's the catch. You paid 5 years worth, it exceeds the time frame. You can't take any of it. You can only take for this year. So it's things like that that do get a little bit tricky. But I mean, and then you have other things like inventory, right? Do you want to talk about inventory, Daniel?
No.
All right, I'll cover it. So inventory traditionally, right? If we go back a few years, let's put ourselves back in like the 2010 days, it didn't really matter what basis you were on. Inventory is not something you've ever been able to expense, right? So let's say that you sell coffee and you're a coffee shop. So you buy your bags of coffee and you buy a bunch of them, right? You got $10,000 worth of bags and they're sitting there in your storage room. Well, you might have spent $10,000, but you're not getting a $10,000 expense until you use the coffee in your business. So pretty much every single cup of coffee that you're making, you're getting an expense for the beans that you're using up from your inventory. So essentially with inventory, you're going to capitalize the asset that you're purchasing and then you expense it little by little. Now, we had a change in 2017 where small businesses are actually allowed to expense their inventory, which is crazy. It's that had never been a thing before, but they did an exception. And here's the key to that exception. If the IRS determines that it does not actually reflect the economic situation of your business, they can reject it.
So, Camille, I'm going to ask you this. We have a med spa company that I noticed in 2024, the preparer expensed all the inventory. And so the ownership changed in 2025. So the the new one of the new owners was like, well, should we have expensed that inventory? And with that change, are they permitted to expense that inventory, or was this guy just trying to lower 2024 taxes for their client?
So the thing is, most preparers, most accountants are not always up to date with everything,
Hmm.
right? If you think about Joe, who started his business 40 years ago, he's likely not seeing all the changes that happen on a yearly basis. And so he's been doing inventory one way for 40 years. He's going to keep doing inventory that way for 40 years again.
Yeah.
So could they have expensed the inventory? Because of the changes, yes, they could have. Did they have to? No, they can still capitalize it like you normally would.
Yeah.
So if it was expensed, that is okay. Let's say it wasn't. You have a new owner.
Mhm.
There's, what you should be doing based on the IRS, and then there's practicality. And generally speaking, we'll take the approach of let's get you to have your filings for this year correct, and we'll worry about previous years if you have to.
Yeah. Yeah, it's so interesting. It gets really complicated really fast. So I would say like if somebody's really considering switching to accrual, it should be because they have to for the most part. It shouldn't be because, hey, this is going to alleviate a burden for you just for 1 year, only to have to pay it again.
Right.
So let's just say somebody's reaching that revenue number where they're going to be mandated to switch to accrual. That's when you want to assess, okay, what is this going to look like for my business? That's worth the expense of getting your accountant to do the 5-year review and make sure you're also ahead of any unexpected liabilities or finding ways to mitigate those versus just doing it because it seems like a good idea.
Yeah.
The only other way I would say yes, switch to accrual is if we notice trend or year after year after year, it would have been better for the client to be on accrual versus cash basis, which again, kind of is rare. You'd have to have a lot of, different, I think a higher complex company to really show like, yeah, accrual basis is a better way to reflect our financial activity and also for tax reporting purposes. It's more efficient. So again, it's really a case by case scenario, but I would say for our solopreneurs, cash basis, hands down, is
Yeah.
is the way to go.
Nice. Yeah. And like our main audience, is solopreneurs. So I think talking about this is just good for them to understand the difference, like what is actually happening,
Mhm.
why they would need to be accrual, which we've explained. Is there any other things that solopreneurs could know like about this topic that may help them, or do you think we've about covered it?
I think we got
I
two
would,
more.
yeah, go ahead.
Yeah.
So the first one, something that tends to get people in trouble, right? Constructive receipt. We kind of touched on it. You get the money, you have to pay taxes on it if you're on cash basis. So what do people do? Well, people like to play games with this as well. Well, Billy sent me a check for $5,000 for the work that I did or the work that I'm going to do. I know it's in my PO box. Let me send my cousin to grab that check, and I'll have my cousin give it to me next week because we're at the year end and I'd rather report this next year. Your cousin's considered your agent. First off, the moment that check is in your PO box, that's already constructive receipt, right? But let's say you sent your cousin to this person's house to collect that check. It's the same thing, right? He's your agent. It's constructive receipt. You have to put it in that year that you received it in. So no tricks there. And then just kind of wanted to touch on the industry specifics, right? There are industries where accrual makes a lot more sense than cash. And two very simple examples that I'm very familiar with: construction. Again, you can do so much with contracts that it really is helpful. And for the most part, it does make sense because they are such long-term projects that even if you have the cash up front, it wouldn't it wouldn't be true to the financial situation of the company to recognize everything when you know you have so many expenses related to that project that probably won't happen for another 6 months to 2 years. So being able to use those contracts and do things in phases is very helpful. And the other one is insurance companies because they have, I mean, they project out their losses for about 20 years. So it's very it's very good to use the accrual method for insurance companies as well.
Absolutely. And I would say, lastly, if a solopreneur is looking to be a serial entrepreneur where they're investing in, maybe a particular startup that could scale, especially like inventory based, it would be good for them to familiarize themselves with accrual versus cash. It may be simple for their business, but a lot of these solopreneurs are coaches and consultants, and they're consulting other businesses and how to help them be, more efficient. And maybe they're looking at their profit and loss as a way to see, like, what have I done? Like, let's say a marketing consultant is, giving specific guarantees and wants to be able to understand, like, okay, what was the impact if that client wants to share their financials, right? But they probably want to understand a little bit about the cash basis versus accrual and understanding. So whether it's, for other clients they work with or other partners, or even their businesses they're considering investing in, 9 times out of 10, they're going to be given a prospectus with financials. They want to understand, what am I looking at here? Is this based on accrual or is this based on cash basis? So it's important to just have a little bit of an understanding. You don't have to have the in-depth that we do and get too tied down to these details, but it's good to be informed.
Exactly. Well, thank you guys both. This was
Oh,
great.
wait. I think
Oh,
this is great. This is great so that we can touch on one thing that
please.
makes me laugh all the time. And I think Daniel's going to smile really hard at this one. Cash basis taxpayer. They did some work for a client,
Mhm.
and the client's supposed to pay them $5,000. Then the client decides they're not going to pay them $5,000. Now, a taxpayer comes to us and says, "Hey, this
Oh,
client didn't pay me $5,000. I want to write that off."
oh,
Well,
this
here's the
happens all
question.
the time.
It all the time, because people do
Uh,
not understand bad debt expense. They just don't. First, the IRS does require you to use the specific write-off method, which means you're not just making up these percentages of what you think your bad debt is going to be or anything like that. No, you sent somebody to collection. You were not able to collect on this. You write this specific debt off. Okay. In a cash basis, you did not recognize income because you don't recognize it until you actually collect the money. So the recognition of income never happened. So when your client says, "I'm not paying you," there's nothing to write off at
Yeah,
all.
you may feel the loss because you were expecting some income, but never in the history of your financials or in your taxes did you ever report that income on the cash basis. Now, there's another situation I've seen where cash basis taxpayer has lend money to an outside party that's not related to them, and they disappear. But essentially you can write off, but
Yeah.
again, it's one of those things. Like, I think we had a construction company not that long ago was like, hey, we need to write this off. And we know, we both, me and Camilo, are trying not to insult the client, but their cash basis, and they're overthinking it. It's like, just delete the invoice then, or void it for records, and just note, the customer didn't pay or defaulted or disappeared or whatever, but there's nothing to write off because you're not on the accrual basis. You never pay taxes on that income.
yeah.
So it's actually simpler than you think. So great point, Camilo. That was, if anything, that should have been one of our main things to talk about when it comes to cash and accrual, because we do see that often.
Yep. And then the other one is like things like refunds or liabilities that you're carrying constantly. Like a lot of businesses offer a money back guarantee. So in cases like that, you probably want to be using accrual so that you can reduce the amount of income that you're recognizing based on those liabilities. Or things like, if somebody is selling gift cards, for example, a lot of gift cards go unused. So there's a
Yeah,
lot of these companies that have millions in in their balance sheet that's just not reflected in the profit and loss. So there's, it's all about industry specifics, and that's where talking to your accountant really matters. Letting them know the industry you're in, the specifics of your, the ins and outs of your business.
absolutely. Like, for example, we have a client that they flip houses as part of their overall real estate operation. And one of the houses they sold, it was tied up in escrow. because there was a lawsuit between
Mm.
one of the partners. And so they were really worried that like we never got this income. And so with that situation, it's like, yes, you're right. It never was received. So we're still going to note, this project being closed out, but instead of recognizing the revenue, we'll recognize it as a liability until it's paid. And once they actually receive the cash, then we recognize the revenue.
Yeah.
Yeah. So yeah, every situation's a little different. So
Yeah.
just be aware of the changes.
Well, thank you both. Some really great stuff here. And thank you guys for listening to today's episode of Tax Mastery for Solopreneurs podcast. If you haven't picked up a free copy of the 7-Figure Solopreneurs Tax Playbook, where we share pretty much all our strategies. We have a whole list in there for you, and we kind of walk through the main 10 steps that every solopreneur should be taking, or at least considering, to start saving that $20,000, $50,000 in taxes a year. Make sure you pick that up at oakenshieldtax.com or below in the description. But thank you for joining us today, and we'll be back for another episode. But until then,
Let's save some money.
let's do it. Thanks for watching.
Thanks.